In November of 1910, something unusual happened in the United States. Late at night, at a quiet train station in New Jersey, a small group of powerful men quietly boarded a private rail car. They did not arrive together. They avoided reporters. They carried minimal luggage, and they gave strict instructions to the train staff. During the journey, they would only address each other by their first names. No last names, no titles, no introductions. Secrecy was essential. The men inside that train included some of the most powerful bankers and financial experts in the United States. But if the public had discovered where they were going and what they were planning, it would have caused a massive political scandal. Their destination was a small private island off the coast of Georgia called Jekyll Island. At the time, the island was home to an exclusive private club used by some of the richest families in America. The members included names like Rockefeller, Morgan, and Vanderbilt. But this trip was not for vacation. For the next 9 days behind closed doors, these men would design a plan that would transform the American financial system forever. That plan would eventually lead to the creation of the Federal Reserve. But to understand why this secret meeting was necessary, we have to go back a few years earlier. At the beginning of the 20th century, the United States had a serious financial problem. Unlike many European countries, America did not have a central bank. The banking system was fragmented and unstable. Thousands of banks operated independently across the country. When times were good, the system worked well enough. But when fear entered the financial markets, there was no institution powerful enough to stabilize the economy. As a result, financial panics were common. Banks would fail, investors would panic, and ordinary people would rush to withdraw their money. These events were known as bank runs. And once a bank run began, it could spread rapidly from city to city. One of the worst financial crises in American history arrived in 1907. It became known as the Panic of 1907. The crisis began when several financial institutions in New York collapsed after a failed attempt to manipulate the stock market. As rumors spread, people across the country began withdrawing their savings from banks. Within days, fear spread throughout the financial system. Banks began running out of cash, businesses could not get loans, the stock market plunged, and the entire American economy was suddenly on the edge of collapse. At that moment, the United States government had very limited tools to stop the crisis. There was no central bank, no institution responsible for stabilizing the financial system. Instead, the responsibility fell to one man. His name was J.P. Morgan. Morgan was already one of the most powerful bankers in the world. His influence stretched across railroads, steel companies, and major financial institutions. When the panic reached its peak, Morgan invited the leaders of the largest banks and financial institutions to his private library in New York City. Inside that library, the most powerful figures in American finance gathered around a large table. For hours, and sometimes through the night, they debated how to stop the financial collapse. Morgan personally examined the balance sheets of failing banks. He forced rival bankers to work together, and he organized emergency loans to stabilize the system. At one point, he even locked several bankers inside a room until they agreed to support a rescue plan. Slowly, the panic began to calm. Confidence returned to the markets, and the financial system stabilized. But the events of 1907 revealed a dangerous truth. The American economy had been saved not by the government, but by a single private banker. Many politicians and economists realized that this situation was extremely risky. What would happen if the next crisis arrived and there was no one like J.P. Morgan to intervene? The country needed a system that could prevent future financial disasters. This idea eventually led to the secret meeting in 1910. The man who organized the meeting was Senator Nelson Aldrich. Aldrich was one of the most powerful political figures in Washington and the chairman of the National Monetary Commission. After studying banking systems around the world, Aldrich believed the United States needed its own central banking system. But the political situation in America made this idea extremely controversial. Many Americans deeply distrusted banks and financial elites. They believed that powerful bankers already had too much influence over the economy. If it became known that a group of bankers was secretly designing the nation's financial system, the public reaction could destroy the entire plan. So Aldrich decided the meeting had to remain completely secret. He invited a small group of bankers, economists, and financial experts. Together, they would design a new financial system for the United States. To avoid attracting attention, the group agreed to travel together in a private railroad car. They departed from New Jersey under strict secrecy. Even the train staff were not told the identities of the passengers. After a long journey south, the train finally arrived near the coast of Georgia. From there, the men traveled to Jekyll Island. At the time, Jekyll Island was one of the most exclusive private resorts in the country. It was quiet, isolated, and perfect for a meeting that needed to remain hidden from the public. For the next 9 days, the group worked intensely. They spent hours discussing the weaknesses of the American financial system. They studied European central banks, including those in England and Germany. They debated how much power a central banking institution should have. And they tried to design a system that could stabilize the economy without giving too much control to private bankers. Slowly, a blueprint began to take shape. The plan called for the creation of a central banking structure that could control the supply of money and provide emergency support to banks during financial crises. Instead of a single powerful bank, the system would include several regional reserve banks across the country. These banks would work together under a central authority. This design was intended to balance power between the government, private banks, and regional institutions. By the end of the meeting, the group had created a detailed proposal for a new American banking system. But the plan could not be presented to the public immediately. The political environment was still hostile towards central banking, so the proposal had to be carefully modified and introduced gradually through Congress. Over the next 3 years, the idea evolved into what became known as the Federal Reserve Act. Finally, in 1913, the plan became law. President Woodrow Wilson signed the Federal Reserve Act on December 23, 1913. The United States finally had a central banking system. The Federal Reserve gained the authority to regulate banks, manage the money supply, and act as a lender of last resort during financial crises. Over time, the Federal Reserve would grow into one of the most powerful financial institutions in the world. Its decisions influence interest rates, economic growth, inflation, and financial markets across the globe. And yet, the origins of this powerful institution trace back to a secret meeting on a quiet island more than a century ago. A private train. A group of powerful men traveling under false names, and 9 days of discussions that reshaped the future of American finance. Even today, the story of the Jekyll Island meeting remains one of the most fascinating moments in financial history. Because behind the public laws and institutions that shape our world, there are often hidden moments where the future is quietly decided. And in 1910, on a small island off the coast of Georgia, that future was written.